California's real estate market's on the brink of collapse. Just kidding. That was a 1982 article that I like to hang on to. I love this quote. It says, eventually the whole thing, California's real estate market, has to come tumbling down around our ears. And when that happens, it will be like the 1930s again, only this time it will be Californians leaving for Oklahoma. Well, we do know there's some decent amount of people leaving for Oklahoma, but it's not because of the real estate market in and of itself pushing them out. It's because of affordability. So this is pretty interesting. I want to keep this in perspective. At the time, rates were, hey, you could lock it in, 30-year mortgage, 11.99. But what I really want to show is you could buy a new home right here for 50 grand. So this just goes to my point. If you can afford a home, time is your friend. Stop trying to time the market. It's all about time in the market. If you bought that house for $50,000 and just barely made dents, refinanced along the way, you're looking at probably $1 million in equity at this point in time. So, if you guys are out there, you're worried about this rate and that rate and a quarter point move and a half point move, don't. Can you get approved for pre-approved for a mortgage? Can you find something that meets your needs? Not all of your wants, right? This is not your forever home. This is a get you in the door home. You got to pull that trigger. So let's jump into the news, right? So the 2023 housing market is at odds with itself. And it is pretty interesting. So it's talking about a paradoxical picture emerging as the spring market is underway. On one hand, you got elevated mortgage rates, which are eroding buyers' purchasing power, as we know and we talk about often. And we have home prices actually going up in our market, right? Because inventory is uber low. So we have a lot of competition in our market. I get that some markets have home prices falling, but that is not typical in our market. We see stuff selling at the last close, if not well above the last close still. So we've got this weird restrained housing market. So what can we expect in 2023? This sounds like my friends who are out in the dating scene, right? It's buyer disappointment. Be disappointed with what you see out there, right? But this disappointment is don't expect to score a deal. It's not out there. If it looks too good to be true, it is. It's either an auction property or it's a cash only property. It's a fire damage, something like that. So if you see something and it's priced too low, shoot that out to your agent. Let them give them the address and everything, and have them run the background on it. See what the private remarks are on the MLS. There's normally a reason. Everything that somebody sends me that seems like a steal, it's got fleas. So it's something that you normally can't buy. So on top of that, mortgage rate fatigue. I think that is like dating app fatigue for my friends that are dating out there. But yeah, rate fatigue. So everybody's talking about these rates. Look, they are still historically low where they're at. My goal is getting my clients in as soon as they can afford something. And all the economists we're following, they're talking about potential for rate drops in the next 1 to 2 years as we get further into this inflation and the Fed gets stuck in a position where they need to stimulate the economy again. And we'll get into a little bit more on the Fed rate increase and stuff on these next couple slides here. But the other thing we got in 2023 that this article completely nails is selective sellers. There's really very few sellers. A lot of them have been in their home a long time. You've got a lot of people that are unfortunately dying, a lot of people that are moving into nursing homes or moving in with families so they can be taken care of. A lot of these sellers have been there their whole lives, are super picky on what offers they want to accept. Special terms as far as rent backs and things like that really matter. So those sellers can definitely be selective. I see a lot of cases where the sellers aren't even taking the highest offer. They just want the best fit. Somebody who's got very strong financing that can make the escrow a smooth escrow. And even though it's not necessarily fair housing compliant, you see a lot of these sellers talking about they want to leave it to somebody that reminds of themselves, and that's definitely not something we push because it can be definitely against fair housing. We always let our sellers know, hey, if there's love letters coming over with these offers, we need to not look at them. We just need to look at the offer as it sits black and white on the pages and not read too much into who these buyers are. So, and look at the best fit based on that. So if you're a seller out there, be very wary about looking at any buyer love letters. I would not say, oh, I want a nice family to take. Nope. that is absolutely against fair housing. You can get sued over it. So be very careful if you're a seller out there and that's something you want to do. We highly advise against it, but I understand there's still some sellers that just don't care. So and then atypical seasonality. Normally this is the hot season, right? We got the spring market rolling right into the summer market. It's going to be very atypical because a lot of the inventory coming up is not moving. They're not selling because of the normal reasons, like, oh, I gotta, put it on the market and move during the summer so I can have my kids in the next school district before the school year starts. A lot of the sellers are moving out of town. Again, they're downsizing, they're dying. It's a lot of older homeowners putting their homes on the market right now. You do have some people that still need to sell for work and move for work. You have some people that are just, trying to, move up, but majority of it, I see a lot of my move up buyers keeping their existing property as a rental and moving up because they've built equity. They've then saved up more money and they can cash flow that property that they're in now and they can move up, which is pretty wild to see that people can do that in the 3 years in this California market. But that's why another reason that we just have lower inventory. So that's something to absolutely expect for the rest of 2023. I see that playing out from here on out. So some of the headlines here. So after First Republic's rescue, economists predict further pain with a new era of higher inflation. What's really interesting is some of the first bank collapses, you had a lot of concentration of depositors that had money that were over the $250,000 FDIC limit. So you had a lot of companies, rich individuals, stuff like that. And so these banks saw bank runs, right? Because people were worried once they got word that this bank might not be around and they went and took their money out and it caused a collapse. Also, you have these banks that have a high concentration of their assets in certain fields. So obviously we saw one was commercial real estate. So right now, commercial real estate, a lot of these properties, they have like 5-year balloon payments, and these properties need to be re-underwritten and a new loan has to be, achieved. A lot of office space tenants and let's call it San Francisco and the high tech areas, right? New York, a lot of them are not fully back. A lot of these companies are not using all their space. They don't want to re-up. They're offering subleases, pennies on the dollar. And so a lot of this commercial real estate values has dropped significantly. So some of those banks are under worry. So you're going to be starting to hear a lot of headlines as far as these bank runs. This is not like 08. This is not, because they gave all this funny money out on residential real estate. There is going to be some, I believe, commercial real estate fallout. A lot of, like I talked about, those high rises and stuff. You're already seeing some banks or some, actual operators of those units handing them back to the bank, and we're seeing some of those assets come back as REO. We're starting to see some auctions of that stuff come out, but those are, we're talking these $300 or $300 million homes, high rises that are now selling for $60 million, right? Opening auctions starting at $60 million on a $300 million place, and they're talking they'll be lucky to even get it on some of those. I think that one was in San Francisco. I saw that auction on. So we expect more pain for the bank. And banks in general, and we're following a lot of that, and we'll keep you guys posted on that. But what you need to know is when you see that a lot of those are because of real estate loans, just note that they're commercial real estate loans. The residential real estate mortgage market and the secondary market is still very, very strong. So another headline, this Fed rate increase might be good for mortgage rates. I've heard this from a couple different economists. They actually think that the Fed is switching from just looking in the rearview mirror, only looking at, their inflation data and not really looking forward of where they think that inflation data is going to be based on what they're seeing as far as, unemployment headlines, a lot of these large employers laying people off, things like that. They're not forward looking. They're only looking, on months old data as it hits their desk. So they're now starting to say they're going to look a little bit more forward. It looks like they might stop on these rate increases, and that would give interest rates as far as 10-year treasuries, which then are going to flip over to our 30-year mortgages, right? Because they're very close. That they actually might trend back down again. So that's very good. I've seen a lot of economists talk about that and think that they're going to see rates falling into the end of this year. So hopefully we see some lower inflation as well, and that will be looking at lower mortgage rates. So that's what you want to keep your eye on. If you hear lower inflation, that means rates are most likely going to be coming down. So those of you out there, you want to get in, you want to get good loan term rates, right? You want to also have a seller accept your offer. The problem is, I talked to an agent yesterday, they had 47 offers on a property. I just got an offer accepted. There was 8 offers on the property. There are very few properties for sale. You need to stick out. One of the ways is having your agent communicate well with the other agent. That's something I really try and pride myself on, is building a little rapport, show them that I'm going to be a very good agent to work with. And our 30-day marriage is we're in escrow, right? But also, there's things you can do as a buyer to make yourself look stronger. And one of those is by putting more money down on your down payment, because it looks like, hey, if we hit a snag on an appraisal, or if there's anything called out, the bank's going to give you less hassle of getting a loan because you're putting more money down, and therefore there's less risk for that bank. So one of those ways we talk to a lot of our clients is using your 401k, borrowing money from it, paying yourself back, and that actually makes you look a lot better on paper. So there's a lot you want to know before borrowing from your 401k. If you're interested, click the link below and you can download our 401k guide for using your 401k to buy a home. And this is going to give you all the benefits of it and things you want to definitely ask your 401k administrator ahead of time so that you know that it's going to work for you and what those payments are going to look like. If you just pull money out of your 401k, you normally are looking at a 10% penalty. You normally will have to pay tax on it, right? And so one of the ways is you can borrow money from your 401k, don't take it out, you borrow it, and then you actually make payments back to yourself. I talk to a lot of people right now, their 401k is going negative because they have it in stocks that are going down. A lot of them have moved it to cash and it's just sitting there and they're losing money because of inflation. Normally, if you're borrowing money from your 401k, you're gonna have to pay 1 or 2% on top of the prime rate back. But that's, you borrow your own money and you pay it back. And what's normally nice is you can deduct that interest you're paying because it's part of your housing interest. You can deduct it on your taxes a lot of times. I'm not a CPA, so you definitely need to talk to your CPA on this. But I've been told by the CPAs I've worked with, their clients in the past have been able to deduct their interest, their pay on their 401k loan, right? And then it's going into their 401k and it's not being taxed in their 401k as growth. So right now, why wouldn't you want to push money into your 401k as much as you can if it's tax? There's a big tax benefit, right? So it's very advisable for most people right now. Not everybody. You definitely want to look at what your 401k restrictions are and what your administrator has set as guidelines to see if it works for you. But normally it makes sense to borrow it, pay yourself back, you put that money down. Now, because you're putting more money down on your loan purchase, normally you can get you can get better loan term rates, right? Which is a lower mortgage interest, maybe less mortgage insurance. And so when you look at the cost savings over there, it actually becomes very, very beneficial. So obviously there's some caveats. You want to make sure you're going to be able to pay that money back. Normally you want to chip away at that a little bit faster because it's at a higher interest rate. But if you guys have any questions on it or any interest in exploring that, please message us below. We'd love to go over it with you. Look at who your plan administrator is and kind of show you some of their guidelines. If you know anybody who could, really use this information to benefit them, they're, maybe looking at, starting to look for a home or been looking for a home and getting beat out, please share this video with them. We'd love for this information to get out to more people so they can use it to be basically putting themselves in a better position to build equity over the long term, right? So when they look back and they see that $50,000 house from 1982 that, grew them $1 million, they'll remember you for sharing this with them, right? But anyways, yeah, definitely go below, hit the like button, please. We really appreciate it. Please share this, like I said, and hit the subscribe button if you haven't already, and turn those notifications on so you get notified when we go live, which is Monday through Friday. And here is an update from Optimal Blue with yesterday's 30-year conforming mortgage rate. We're still hovering around that 6.37 range. We've been kind of bouncing between the 6.2, 6.4 range here. Obviously, there's a lot that goes into lending right now. It's all risk-based. So if you guys have questions on loans, please reach out to us as well. We'd be more than happy to help you navigate what loan programs are out there for you and what those interest rates would be. So again, using your 401k, it can be very beneficial for most people in this market. So definitely check that out. Pay yourself back. Don't lose money in the stock market right now. Give yourself that guaranteed gain by borrowing it yourself and betting in yourself and getting yourself across that divide from being a tenant flushing your money down the toilet with rent to a homeowner where you are in a forced savings account. You're paying down your loan balance on your, you're borrowing from the bank and you're paying yourself back and gaining interest and gaining money in your 401k at the same time. So thank you for joining us, and peace.